Did you know in Sri Lanka, more women go to university, but fewer women join the workforce? Financial freedom is the key to empowerment.
ශ්‍රී ලංකාවේ කාන්තාවන්ගේ මූල්‍ය සාක්ෂරතාවය සහ රැකියානියුක්ති ප්‍රතිශතය සාපේක්ෂව අඩුයි.
இது மாற்றத்திற்கான நேரம். It's time for change. As we celebrate International Women's Day under the theme Invest in Women, Accelerate Progress, join our webinar series FinPower Her, empowering women through financial wisdom.
Let's build a future of strength and independence together.
Let's build a future of strength and independence together.
Let's build a future of strength and independence together.
First Capital proudly claims. First Capital proudly claims the pinnacle of success at Slim Brand Excellence 2024 Brand of the Year. This prestigious win reflects our commitment to empowering lives and building secure financial futures for all. First in excellence, first in trust. First Capital, the Brand of the Year for a reason.
Welcome to the First Capital Mid-Year Outlook Investor Forum 2025. I'm begin with a presentation capturing Sri Lanka's economic outlook for the remainder of 2025 and the first half of 2026. It will also feature practical investment strategies aligned with current market realities. Delivering this session is our very own Mr. Ranjan Ranatunga, Assistant Vice President of Research at First Capital. We will then move to what I believe will be an engaging and enlightening panel discussion featuring eminent industry leaders, which will then be followed by a Q&A session. Your panelists for the day include Mr. Joseph Christopher Joshua, Executive Vice Chairman of Access Engineering, Mr. Moise Remanji, Group Chief Financial Officer of Hemas Holdings, Mr. Kushan De Silva, Director and CEO of Haley's Advantage Bunkering, and finally our very own Mr. Dimantha Matthew, Chief Research and Strategy Officer of First Capital Holdings. At First Capital, our vision is to improve the lives of all Sri Lankans through financial solutions. Staying true to this vision, I'm proud to announce that for the first time, we'll be interpreting this event in Sinhala as well as in Tamil. This initiative is aimed at improving accessibility and making financial knowledge more inclusive for a wider audience. To select your preferred language, simply use the interpretation feature on Zoom during the session. First Capital ආයතනයේ දැක්මට අනුව මූල්‍ය පිළිබඳව දැනුම වැඩි පිරිසකට ලබා දීම සඳහා අපි අද මේ වැඩසටහන සිංහලෙන් මෙන්ම දෙමිල භාෂාවෙනුත් පරිවර්තනය කරනවා. ඉතින් Zoom තුලින් මේ ඔප්ෂන් එක ලබා ගන්න කොහොමද කියලා බලන්න අපි දැන් වීඩියෝ එකක් බලමු. Thank you for that, team. To tell you a little bit about First Capital, we are a member of the Janashakti Group, focused on delivering performance at the Slim Brand Excellence Awards, which is the highest recognition any brand aspires to secure. We have also earned recognition for financial reporting at TAGS Awards, as well as we have been recognized for innovation at the National ICT Awards for our in-house platform, First Capital Invest. Taking over the presentation to dive into Sri Lanka's 2025 mid-year investment outlook and to help you explore key macro trends, shifts in equity markets, as well as changes in fixed income is Ranjan Ranatunga, Assistant Vice President of First Capital Research. Ranjan has over 10 years of experience in both local and foreign equity markets. Prior to working in Sri Lankan equity markets, Ranjan worked as a senior analyst catering to both buy-side and sell-side funds in the US as well as in the UK. Ranjan holds a bachelor's degree from Staffordshire University of the UK and holds ACMA and CGMA qualifications to his name. Now, bear with us for a few minutes as we welcome our presenter on board.
Right. Thank you, everyone, and thank you for joining us today for our Midday Outlook presentation. So before we move on to our presentation, let me share a quote by former President John F. Kennedy. Every action has a cost and a risk, but the risk is far greater when you consider the long-term risk of comfortable inaction. I think this quote is very suited for today's capital markets. Looking at how Sri Lanka has performed, Sri Lanka has gained a lot of stability since 2022. Interest rates are stable and inflation is cooling off. For most of the investors, this is a very positive sign because this gives a lot of confidence to its investors. However, there's a far bigger question lying underneath the surface. That is stability enough to deliver the desired growth? So, considering this, let us look at in the next 30 minutes how we have fared and what we will be presenting and what our outlook for the next 12 months for Sri Lanka. So without further delay, let's move on to the presentation. So starting off with the track record. So we have 5 levels of accuracy to measure the accuracy. And to start off with, we are looking at 6 economic indicators, and of which tourist arrivals, tourism earnings, worker remittances, and private sector credit growth has all been in line with our expectations. However, inflation has been well below expectations, mainly due to the fact that of an unexpected exit tariff adjustment that we saw in the month of January. Meanwhile, looking at reserves are slowly growing towards our target of 7 billion that is set for 2025. Moving on, we have the bond recommendations. So the first half of the year, which is starting from 21st of August 2024, proved accurate for First Capital Research, where we expected bond rates to come down by 100 to 150 basis points, driven by decline in policy rates. But however, the investment strategy we presented from January proved inaccurate because we were expecting rates to slightly move up with the pressure picking up from the economy. But however, due to the lackluster pressure that we saw in terms of GDP growth as well as on interest rates, we saw interest rates holding steady. However, with the new recommendation presented from 28th report, we were expecting yields to come down slowly, mainly due to the surplus liquidity that was available in the system. And this proved right, with rates coming down, rates adjusting down, with policy rates being cut by 50 basis points as well. So, analyzing the bond recommendation, our recommendation proved partly accurate, with first half bond yields coming down in line with expectations, while the second half, the yield adjustment, down adjustment was in line, not in line with our expectations. Policy rates also proved most accurate, with policy rates being very much in line with our FCR First Capital Research expectations. Moreover, First Capital Research also forecasted that central bank will move on to a single policy rate in the November policy meeting, and this proved right, with central bank adjusting, moving on to a single policy rate and with a rate cut of 75 bips. However, the May policy reduction of 25 basis points was not in line with expectations. Moving on, we have bank rates. So bank rates also proved partly accurate, with banking rates in the first half staying in line with our expectations. However, again, with the reduction in interest rates, together with the fact that the banks were lending only to the big corporates where the demand was surfacing from, brought down risk of the banks towards very low, and this brought down AWPR towards the risk-free rate as well. In terms of exchange rate, our exchange rate proved accurate, with the LKR hovering around 300 mark during the first half of 2025. While on equities, equity recommendation proved accurate as well, with SPI growing by 48%, driven by political stability as well as improvement in corporate earnings that we saw during the last 12 months period. Next up, we will look at key elements that you need to consider when you are investing in 2025. First of all, the theme for today is set as steady but slow. Why are we picking this theme for today? Is mainly because Sri Lanka has achieved a lot of stability, as I mentioned before. We have seen economic stabilizing and interest rates coming down. But however, this is not enough. And the GDP growth is coming in slow during the next 2 years, mainly because of this. So what needs to be done? Let's look at it next. Starting off with the political outlook. So in terms of political outlook, we maintain our risk category as low risk. So during the last 12 months, Sri Lanka had 3 elections in total, with presidential election taking place in September, while the parliament was followed in November, and the more recent was the local government election that took place in May of this year. And the governing party won all 3 elections and secured a majority as well. Looking ahead, we have the provincial elections happening within the next 12 months period, and we expect the governing party to win this election as well. What does this mean for the investors? So when you're looking at with governing party winning all elections, we are looking at political stability for the next 5 years and proper direction for Sri Lanka for the next 5 years. We believe this is a very good thing for investors because this gives a lot of confidence for the investors regarding the outlook for the country. Moving next, let's look at the economic side of things. So in terms of economic outlook, we continue to maintain our risk stance at medium-low risk, and let's look at why. Starting off with GDP. So GDP in 2024 grew by 5%, and this is after 2 years of contraction that we saw during 2022 and 2023. And the first quarter GDP came in at 4.8%, near our upper threshold set for this year of 4 to 5%. However, looking ahead, we expect GDP to slightly slow down between 3 to 4% for both 2026 and 2027. The main reasons for the GDP slow expected is mainly coming off from the weak capital spending from the government, also partly attributed from the global slowdown that we are expecting from the developments that is happening globally. Then let's look at what brought in stability during the period. So a lot of stability was brought in from lower than expected inflation. So inflation has been steady and it has been slowly going up towards the central bank desired threshold of 5%. So although we don't see inflation rising in the year of 2025 to the central bank level of 5%, we will see it getting slowly there in the year of 2026. And this will be mainly driven by the improvement in demand in the local economy, while the base effect that was created from deflation in 2025 is also expected to support inflation climbing towards the 5% mark. Then we have the budget-driven support. So as you know, the latest budget gave in many support to the consumption, which is through assessment program, public sector salary increases, private sector salary increases, and pension increases. So all these things are expected to benefit consumer and drive GDP growth in the coming year. However, there's one thing that is limiting growth, that is the lower capital expenditure. So when you're considering capital expenditure, the government set aside 1.3 trillion rupees for 2025 to spend through capital expenditure. But however, only 113 billion has been spent so far for the up to April 2025. And this number has been very much low considering the fact that last year with low spending, even still higher than the current number of 113 billion. The lower capital expenditure was also evident from weaker credit demand that was seen by the state. So if you look at the chart, you can see Sri Lanka went through 2 years of state credit contraction during 2023 and 2024. And right now what we are seeing is state credit slowly recovering from the month of March onwards. Looking ahead, we expect state credit to grow slowly at 5% and 7% for next year, while private sector credit will grow up by 15 to 12% on the following year. Although we expect credit to pick up, we believe this is going to be insufficient to boost demand in the following years. And that's why we are expecting GDP growth to be between 3 to 4% for 2026 as well as 2027. Moving next, we'll look at how the government fiscal side is operating. So in terms of fiscal side, we have seen revenue collection improving. Revenue growth has recorded at 16% during the first quarter of 2025. Recovery in the economy, together with the opening up of imports, which has brought in import taxes to country, has significantly boosted revenue during the concerned period. Meanwhile, with revenue improving, we have seen budget deficit also improving, with budget deficit for 2025 coming down to 5.9%, lower from 6.8% recorded in 2024 and lower than the 6.5% that was set from the budget 2025. The main reason for the decline in budget deficit is mainly attributed to the lower capital expenditure, as we have highlighted before. Moving on to the external side of things, we are picking up trade deficit first. So in terms of trade deficit, we are expecting trade deficit to widen, mainly due to the faster growth in imports outpacing the growth in exports that we have seen. So imports has been picking up recently from the May of last year, mainly due to government relaxing import controls that they had in place. The last move made on this move was the relaxation of vehicle imports that we saw in the month of February. So all these things combined is boosting imports, demand for imports, and that is growing faster than exports anticipated. Exports are growing at a very slow rate of around 2 to 3%, and because of these factors combined, we have seen trade deficit expanding, expected to record 6.9 billion for 2025 and 8.3 billion for 2026. However, increase in trade deficit is expected to offset by a couple of things. One is high remittances. So remittances has been growing at a record level for 2025, contributed by a couple of things. One is the increase in migration, while the second is the improvement in labor demand from the host countries, particularly from the Middle East. Also contributing to this positive surplus is tourism inflows. So tourism, in terms of tourism, we are expecting this to be a good year for tourism, with tourist arrivals crossing the 2.5 million threshold, which is the record high level compared to the previous high of 2.2 million set at 2018, while the country is expected to earn $4 billion from tourism inflows, which is expected to contribute towards the positive surplus that we've seen on the current account front. And in terms of current account, this positiveness that is coming from record high remittances together with the tourism is contributing with Sri Lanka expected to meet the third consecutive years in terms of current account surplus. The positive growth in current account surplus is helping the balance of payment as well, where we are expecting Sri Lanka to record a balance of payment surplus of 490 million for this year, while this will increase to $534 million on the following year. However, partly offsetting that increase that we saw in the balance of payment is the debt maturities. So 2025 was one of the lowest years that we had in terms of debt maturities after restructuring its debt in 2024. But however, going forward, we will see debt maturities rising up gradually, and this is expected to pick up significantly from year 2027 onwards. Despite the picking up debt maturities, the positive BOP is expected to trickle in aggressive dollar purchases from the central bank. So if you have a look at the past, we have seen that central bank purchased close to $1 billion from the market in the first half of 2025. And this has helped towards building up of reserves in Sri Lanka. So reserves has been at $6 billion in the month of May, and we expect this to get into $7 billion mark by the end of this year. As I said to you before, the balance of payment surplus is expected to be positive for this, while foreign direct investment as well as inflows from multilaterals such as IMF, World Bank and ADB are also expected to support the strengthening of reserve position. Then let's look at the external side of things. In terms of external, we continue to maintain the outlook as medium-low risk. And let's look at why. So in terms of external outlook, the past 12 months has been a big challenge. We saw wars surfacing in across 3 continents. One is the Iran versus Israel war that is happening, that took place in Middle East, while the India-Pakistan war was also took place in Asia, which were adding concerns to the region. While we have seen Ukraine versus Russia war ongoing since 2022, and that has been still continuing and adding a lot of pressure towards the performance across the world. With wars happening around, together with the recent developments in the global markets, are affecting global growth rates. And we have seen this as major multilaterals around the world is reducing the growth outlook for the world, with all World Bank, ADB and IMF cutting their growth rates. However, central banks are not is expected to counter this slowdown with rate cuts. And we have already seen the Federal Reserve saying that they will have 2 rate cuts during the next 6 months. And the Bank of England has already showed signs that there will be 2 rate cuts during this year as well. While the European Central Bank, being proactive, has already cut rates 8 times so far. Then we have another concern, that is the President Trump's liberation tariffs. So if you have been following the events that has been unfolding globally, you may have noticed that on April 2025, Sri Lanka was placed with a reciprocal tariff of 44%. But with the July update, what I heard is that the tax rate is coming down to 30%. This is a significant reduction. But however, there are a few concerns within this. Although we are placed at 30% taxes, somewhat better than our peers, our cost of manufacturing continues to be higher, with illicit tariff as well as corporate taxes amongst the highest in the world. And this is bringing concern to the export side of things as well. Then, finally, we will move on to our recommendations. So in terms of recommendation, let's look at the bond market first. So when we are assessing the bond market, we at First Capital, we look at things differently. We have something called the health score, which we have compiled using both primary criteria that will affect interest rates as well as some secondary criteria. First, let's look at the primary criteria, which involves foreign reserves, liquidity, inflation, foreign activity, credit and CBSL holdings. While we have maintained our risk levels across all these 6 categories during this year. Looking ahead at the secondary criteria, we have rating outlook, external environment, balance of trade and balance of payment, political risk as well as investor confidence, which has also been maintained based on the risk levels. So looking at all these indicators, we plot this into a chart and we look at how this is going to affect the interest rates. And we have 4 levels of risk categories involved in this, which is high risk, medium risk, medium-low risk as well as low risk. And as you can see here, when the health score crosses the high risk category, we will see a lot of pressure on interest rates. And when it's at the low risk category, we are seeing low pressure on interest rates. And right now, Sri Lanka is hovering in the low risk category in terms of the health score. Looking ahead, when we are expecting capital expenditure to come in, which is expected to boost GDP growth. While on the other side, the pickup of state credit and private sector credit expansion is expected to add some pressure in terms of liquidity. While the inflation is slowly climbing as well. And that is why we are seeing the health score slowly coming in towards the middle low risk category, but still and even during the June 2026, we are expecting to slightly hover in the low risk category, putting less pressure on interest rates. Then looking at policy rates. So in terms of policy rate, we at First Capital believe these policy rate will remain broadly stable in the next 12 months. However, we expect a 25 basis small rate cut to come in to accelerate the slowing down GDP growth that in the economy. We believe a 25 basis points rate cut is in cards following the aggressive attitude that was shown from the May policy meeting by the central bank, where they reduced rates by 25 basis points. We believe another 25 basis is in cards to support the slowing economy in Sri Lanka. So considering the unexpected rate cut that we saw in the month of May, coupled with another 25 basis rate point that is on the cards, we are revising down our yield curve expectations for the next 12 months. Considering this, we are revising down the 1-year bill by 100 basis points to 7.5 to 8.5 for the December, while the 5-year and 10-year bonds have been revised down by 50 basis points respectively. Considering this, we are expecting rates to come down and hover within the bands we have targeted here. And even looking at the following 6 months, we expect, as I said before, we expect pressure on interest rates to be low, and that is why we are expecting interest rates to be more or less stable, while yield curve is also expected to follow the same trend. Then on towards recommendation. So if you have been following us on our reports, we recommended last time to shift to short tenors with a willingness to run a carry portfolio. And we are sticking with the recommendation this time as well, mainly due to the limited downside potential that we are seeing in terms of yield curve, as we highlighted before. So with that, we are again recommending investors to shift to short tenors while with the willingness to carry a running portfolio to reduce capital losses that can come your way. Next up, we will look at banking rates. So in terms of banking rates, AWPR came down more than we expected. As I mentioned at the start, one of the reasons why is that the banks were banks were very risk averse in terms of lending, and only the big corporates were demanding for loans during the first 6 months. And this reduced the risk appetite of the banks, and that brought in AWPR more closer to the risk-free rate. And looking ahead, we are expecting AWPR to hover in the same range, with AWPR between 7.5 and 8.5% for second half of 25, while this is expected to slowly gradually increase to 8 to 9% by the first half of next year. On towards exchange rates. So exchange rate outlook has been more or less accurate, as we have showed in the first slide. And we are maintaining our outlook as well, with exchange rate expected to hover between 300 to 310 within the second half of this year, while during the first half of next year, exchange rate is expected to be between 305 to 315. Next, we will be looking at equity market, which is the last section of our recommendation. So in terms of equity markets, First Capital remains bullish. Few things are combined here. One thing is growing corporate earnings, we are expecting to grow by 25% in 2025 and 17% in 2026. When looking at corporate earnings, we expect few sectors to grow exceptionally well compared to others. First is the capital goods sector, which is led by John Keells, who are unveiling a couple of new projects that will be coming into play from August onwards. First thing is the casino operation, second is the mall, and the third is the West Canning terminal. While the new BYD dealership is also expected to add to profitability in the coming years. Then we are also bullish also on the diversified financial sector, which is expected to see loan growth benefiting the profitability of that sector. While construction, consumer are also within our cards for next year to grow exceptionally well compared to other sectors. Moreover, there's also another attractive point for the stock market investments. That is that stock market is still trading at a considerable discount to its historical averages. So analyzing the past 10 years, what you have observed is that stock market or the ASPI trades at an average P of 12 times normally during the past 10 years. And if you look at it now, right now ASPI is trading at a PER of 8.6 times and a book value of 1.2 times, which is a significant discount to its past trading averages. So coupled with the growing earnings and the significant discount the ASPI offers compared to its past, and the low demand, and expectations of prolonged low interest rates are expected to increase inflows into the equity markets as well. One thing to be noticed is that we are seeing a lot of fund inflows into equities right now, with investors shifting their investment from alternative asset classes. So as you can see in the screen here today, if you compare the fixed deposit rate as well as 1-year T-bill as well as lands, all these are hovering in the 8% mark in terms of returns. And when you compare the stock market, it has given a return of 37.8% year-over-year growth for March 2025. Looking at these factors, we, as I mentioned to you before as well, we are very bullish on equities. And because of that, we are upgrading the target that we set for 2025 as well, with the ASPI target upgraded to 18,000, 19,000. While for the following year, the target is further raised to 21 to 20,000 as the bullishness we are expecting on the equities. So with that, we are continuing to be bullish on equities, and we continue to remain on the buy stance, which is expected to bring in a lot of benefits to investors by moving into equities during the next 12 months. So with that, we have come towards the end of the presentation, and before we wind down, let me get back to the start of the quote, start of the presentation which I shared the quote. Every action comes with a risk and a cost, but the long-term risk of inaction is more riskier than the short-term risks that are there. So it is us to see what Sri Lanka is giving us in the next 12 months, and we will see we will see how these new things is going to translate to economy and help us towards attaining debt sustainability that is in 2027, and that is something to keep an eye on. And with that, thank you for joining us on the presentation, and please give us a couple of minutes to set up the setting for the panel discussion, which will be following next.
First Capital Research takes pride in our commitment to delivering high-quality, comprehensive research and analysis within the capital market and macroeconomic domains. What sets us apart is our ability to deliver detailed and timely analysis on both equity and fixed income investments and covering macroeconomic factors, making us one of the few research firms to do so in Sri Lanka. Our research philosophy revolves around our vision, ensuring that we consistently produce high-quality investment analysis using fundamental valuation techniques. At First Capital Research, we are dedicated to helping all Sri Lankans by keeping up with evolving global research standards to build wealth with confidence. Our focus lies in delivering accurate forecasts and insightful outlooks, empowering investors to make informed and smarter decisions. Through our detailed reports, we provide comprehensive predictions on key topics such as interest rates, exchange rates, bond and equity market trends, offering a solid base of information and future predictions for strategic decision-making. We also cater to a diverse spectrum, including essential reports such as daily market updates, quarterly earnings analysis for the companies and our coverage, detailed corporate updates, sector reports, equity strategy, and comprehensive fixed income reports. This covers sophisticated aspects like company valuations, industry dynamics, projections, trends, and our informed recommendations. In recognition of our commitment to excellence, we are honored to have recently received the Silver Award for Best Equity Research Report at the CFA Capital Market Awards. Our award-winning research, noticed for its exceptional quality and depth, is also made freely accessible to the public, empowering informed financial decisions with a vision of improving the lives of all Sri Lankans through financial solutions. First Capital Research stands as a forward-focused research entity, making all publications freely available online to empower Sri Lankans with informed investment decisions. As one of the few research houses offering open access to expert insights, we remain driven to lead the Sri Lankan investment banking landscape, uplifting lives across the nation.
Okay, now let's move to the panel discussion that we have all been waiting for. I'm pleased to introduce the panelists for today's session. Introducing to you Christopher Joshua. Joshua has played an indispensable role in building and leading some of Access Engineering PLC. He has served as both CEO and Managing Director and currently holds the position of Executive Vice Chairman. In addition, he is Executive Vice Chairman of Satosa Motors PLC and Access Realties Private Limited, and holds several other prominent leadership roles within the group. Joshua has also contributed his expertise as a member of the Monetary Policy Consultative Committee and the Stakeholder Engagement Committee of the Central Bank. Next, we have Moise Remaji. Moise is the Group Chief Financial Officer of Hemas Holdings. He has over 2 decades of extensive experience across diverse industries and global markets. During this period, he has held leadership roles in Sri Lanka and overseas, including in Forbes-listed companies. Moise brings deep expertise in corporate finance, supply chain management, investor relations, tax planning, and IT projects, establishing him as a versatile and highly effective leader in the finance sector. Next, we have Kushan De Silva. Kushan is a seasoned finance professional with nearly 25 years of experience, including over 20 years at Haley's Advantage Group, the transport and logistics arm of the Haley's Group. He currently serves as the CEO and Director of Advantage Bunkering. Through the years, Kushan has been instrumental in contributing significantly to the group's expansion, strategic partnerships, and the development of innovative solutions across diverse segments of the transport and logistics industry. From First Capital, today we were supposed to have on board our Head of Research and Strategy, Dimantha Matthew. However, due to unforeseen circumstances, he is not able to make it today. But worry not, we have Ranjan Ranatunga here amongst the panelists to answer your questions. Okay then, without further ado, let's get this panel discussion going. First of all, let me mention that I'm excited and thrilled to be sharing this space with professionals as eminent and experienced as you. And also to our viewers, please note that you can send your questions in through Zoom, YouTube, and Facebook, which will be answered after the first round of questions. Okay. So my first question relates to those that make up the very core of any economic apparatus. Moise, this question is for you. It's a simple question, but it is one that has sparked a lot of curiosity. So in your years in the arena of retail and consumer-related segments, you would have seen consumer behavior and consumer demand evolve through various and unique economic landscapes. So tell us, has consumer demand bounced back to pre-pandemic or rather pre-crisis levels, and what's your outlook for growth in the coming years? Also, we'd like you to add a little bit on what segments you expect it to come from.
Thank you. All right, so short answer to your question, it has pretty much bounced back to pre-pandemic levels. But the flavor and the manner with which it has bounced back is not entirely the same as it was pre-pandemic. For the simple reason that consumption patterns have changed. If you take the 4 or 5 year period starting 2019, which is when really things started getting bumpy in Sri Lanka, from that date to when things started opening up again in 2023, a lot happened in that period whereby lifestyles changed. There was a lot of newly found health consciousness. There's a whole new generation that came into the adult space. And of course, the more hyperactivated global connectivity through social media. So what consumers wanted then, pre-pandemic, and what they want now has certainly changed. Some basic elementary examples which you can all relate to, things such as laundry, which may have had some brand equity, brand stickiness in the past, is more commoditized now. On the other hand, things which are more aspirational, personal care, beauty, those kind of product ranges have made an interesting shift whereby people are wanting more of it. And they're prepared to pay, surprisingly, more than what we would have originally expected. Because it's about the lifestyle change, it's about being aspirational. And the simple word that articulates that change in lifestyle and change in demand is what we call mastige. And that has definitely taken off, and it's an area to be on the lookout for anyone who's in the space of catering to consumer demand. And that's the area to invest and put your time and efforts also into.
Thank you, Moise, for that comprehensive answer. So I'm going to hold on to something that Moise mentioned, that consumer demand has bounced back to pre-pandemic levels. Although the flavor has changed, the demand in itself has reached pre-pandemic levels. So this takes me to talk about the economic recovery that Sri Lanka has seen in the past 1.5 to say 2 years. We know that a big part of this recovery has been the government's performance. I think it's not wrong to say that Sri Lankan government, maybe last year and even in the first quarter of this year, went on to even overperform certain IMF targets. So, Ranjan, let me pick your brain on this. So the 2025 budget, you know, we worked on this together. projects a robust revenue to GDP ratio, which is about 15%. So this is in line with the upward trajectory that we saw last year as well. So tell us, to what extent is this revenue performance structurally sustainable? And what must Sri Lanka do at present to make sure that this type of momentum remains a possibility in the years to come?
So thank you, Akna. I think that's a very valid question for the current context. So when you look at in terms of the government revenues, we had to first look at how the government revenue went up. So as you can see today, I presented this before now. We saw government revenue going up by 16% during the first quarter. And when you look at how it has come from the increase of taxes that we saw coming in. So coming back to the question, is it sustainable? That is a big question mark, because taxes are like a double-edged sword. So it can increase your revenue, but from the other side, it can impact the consumer as well. So in the long run, boosting revenues through taxes is not the way forward. But I think there should be some sort of a balance between in terms of taxes, how it should be supportive of consumer growth as well, while on the other side it should be supporting growth as well in terms of tax revenue growth. So looking at that, I think what we can expect going forward is, I think as I mentioned before also, we are seeing the GDP growth partly coming off mainly due to the taxes, because if we're taking off the potential that can be infused to the economy as well. So looking back again, what we can expect is some sort of a big balance between the tax revenues, because what we want is, we want consumer or the people to do better in Sri Lanka. So with increase, if you are taxing a lot from the people, then I don't think it is creating that positive impact for the enrichment of people's lives. But of course, we will see tax revenues increasing. But in terms of how fast the economic benefits will trickle down to the lowest part of the economy will be in question. So to answer your question in brief, in terms of sustainability, it's a big question mark. But right now, so that was the first thing that we did as a government in 2022, where we bumped up the tax revenues. Now that we are past that stage, with now today, as mentioned, the revenue to GDP is expected to be somewhere around 15.5% for this year. And that is about the IMF requirement of 15.1%. So we are on track there. Right now, what we can do is find somewhere balance between the tax revenue as well as GDP growth. And so to answer in short, it's a big question, and we are wait and see how increases in taxes driven revenue is going to consolidate and impact the bottom line, that is to how it will enrich the people's life on the ground.
Okay, thank you, Ranjan, for that. So you tax, you also have to give back, which brings us to an important component in the fiscals that we have seen, which is capital expenditure, right? So Joshua, let me turn to you now, right? So you've been attached to the construction industry for many, many years. So paint us a picture of what realistic link exists between state capex and the construction sector of Sri Lanka, right? So as Ranjan also pointed out in his presentation, we saw that while state capex as a share of GDP fell last year, while there have been promises to increase it this year, what has been spent so far falls behind the amount that was spent last year during the same time, right? So how has this slowdown in state capex affected your project pipelines and profitability, and what would a recovery in public capex mean for the construction sector?
So thank you, and thank you for inviting me to be on this panel. Of course, it's a very relevant question, and it's a long drawn answer, but I'll try to condense it as much as possible. Traditionally, the state's capex, they never meet their spending targets throughout. So this is not something surprising for us in the construction sector. The government also did an audit with last year's expenditure on the major projects, where the capital expenditure targeted just to spend within the financial year of 2024 was about $800 billion, out of which, 800 billion rupees, out of which they ended up only spending about 51% of that, just over 400. And unfortunately, that audit report also took a long time to finish, and it came out after almost 6 months into this year. So what's really happened was the funding lines are there. In fact, it's not only the treasury allocation or government allocation for the capital projects, there is also multilateral funding, ADB and World Bank, and of course JBIC, in a big way. For an example, if I tell you the second rural road program by the ADB is already worth about $900 million. So there's a lot of money to be spent if you want very concessional funding. But as you say, the machinery is not moving fast enough to spend them. In fairness to the government, of course, they were just established and they were taking stock of things. And obviously, they had to go through existing contracts, existing procurement procedures, and prioritize what areas need to be prioritized. So they have done that. Most of it is done now. And we see some traction in the project implementation. In fact, tenders are called, but to all our liking, they can be expedited. Procurement delays are there. I'll give you another example. The airport expansion project, which is a big one, stage 2 BIA, which is needed badly to meet even our tourism goals. We are pretty stretched out at the airport. So that the funding was pledged again, $700 million by the Japanese. The tender process took place last year, but the award is yet not made. So I think this learning curve is now over. That's what we feel. And we will see an urgency in getting these much needed infrastructure projects and also rural projects also to generate income to the rural community and the rural economy going through. And so we are quite optimistic in this sector.
Okay. Thank you, Joshua, for your answer. All this talk about recovery, it takes us back to when we were first hit by the crisis, which as Sri Lankans is a reminder to us of how vulnerable we are as an emerging market to external shocks. So, Kushan, I now turn to you, right? So, right now, we are going through a period of heightened geopolitical tension, right? So, tell us, in the event of a geopolitical, in the event of an escalation in geopolitical tension, particularly in the Middle East, say, such as a closure of one of the major maritime choke points, right? How would global trade dynamics shifts, and what impact would this have on South Asian shipping and trade routes, particularly for Sri Lanka?
Yeah, thanks, Akna. I think interesting question, especially as Ranjan showed that we had a couple of conflicts in the region, especially with the Iran-Israel conflict. So as you mentioned, there are two choke points that can be identified, that is the Strait of Hormuz and the Red Sea. So if you look at the Red Sea, we have been having certain amount of congestion because of the Houthi attacks over the period. And that meant that majority of the larger vessels which the Houthis were targeting had to go via the Cape of Good Hope, right? So when it comes to that, the deviation is 10 to 14 days, right? Cost of, say, sending an export went up by, at that point, I think, as the Houthis were targeting vessels, went up maybe even by $1,000 per TEU, right? also the journey is longer. So your bunker prices also would go up. So that is on the Red Sea side. So if you look at the Strait of Hormuz, more than 20% of oil is generated within that region. Iran, Iraq, Saudi, Kuwait, UAE, all these. So plus a significant portion of gas. So it is very likely that if there is a blockade that is done, oil prices would go up significantly. We saw during the beginning of the Russia-Ukraine war, that was about 2022, I think, is what you pointed out, oil prices went up to about $125, $130, right? So today also, at the beginning of the Israel-Iran conflict, oil was about $68. It went up to about $78, but I think the markets had sort of expected that they won't escalate. There are certain reasons why I think they believe that Iran would not actually close, and there are reasons for that. So if it is by any chance close, oil prices will easily go up to close to $100 minimum, right? And that will have a big impact on a country like Sri Lanka, where we are energy dependent, where 100% of our oil has to be imported, whether it be crude oil or refined oil. So there will be a significant cost that can come if it happens, but I personally do not believe that unless there is sort of a regime change that is being planned by the US or Israel, that Iran can afford to close the Strait of Hormuz.
Thank you, Kushan. So while we are on the topic of shocks, right, let's, so Kushan just took us through how certain external shocks, what kind of repercussions would external shocks pose for the Sri Lankan economy. Let's now talk a bit about how certain internal shocks have shaped consumer behavior. So, Moise, once again, I turn to you. So, our shifting consumption habits, I think you mentioned this earlier when you spoke of how the flavor of consumption demand has changed. So, I'd like you to expand a bit on that. And I'd also like you to address whether this shift that you have seen in consumer consumption habits, whether it's a temporary response, right, temporary response to the crisis that Sri Lanka underwent, and also the inflation fatigue that the people had to endure during this time, or a longer term trend that we can expect to see in the economy. And if it is a long-term trend, how is HEMAS planning for this structurally?
So it's not just an abrupt or temporary response to the inflation fatigue, as you put it, Akna. It's a longer-term trend, and it comes, from, first of all, people having the desire to want something different that caters to the new lifestyle that they're aspirational about. And secondly, the ability of a Sri Lankan company to also cater to that. So it's not just about giving the right product that solves the right problem to the consumer, but it's also about giving it at the right price point. Now, the simple analogy I could take is from a standpoint of import substitution. If you take products pertaining to beauty care, beauty products, what's traditionally associated with that kind of a product range is, the global brands. But at what price do they come once they come to the whole import channel? Versus what can you offer, right, from Sri Lanka under Sri Lankan brand flagship, and offering a solution that is also quite localized. Now, having functional therapeutic qualities to something like a facial cream is something that Sri Lankan consumers very much associate to. It may be Ayurvedic, it may be something which is as commonplace as vitamin C, But adding those little ingredients of local goodness into your products, the standard products, makes a big difference. And also what we can see is consumers resonate to this, because it's not a strange phenomena to us that when a well-established Sri Lankan company offers a good product and a good brand, consumers do have an inclination to go towards that versus an international brand, provided you can establish confidence in the quality, the efficacy, and the reliability of the product. So as long as you could sustain that, you could keep offering to the consumers what they have traditionally not been able to get through a local establishment. And that's one key area to play in. And of course, the price point. Can you give it to them at that sweet price point? It cannot be at the premium prices of a typical imported global brand. It has to be something more competitive than that. But point is, it does not have to be low cost, because consumers are getting more aspirational. And apart from that, there are other natural changes also that are happening in the demographics itself. If you take the participation of the female labor force, it's increasing significantly. If you talk about feminine hygiene, the awareness that is being built around it, and the traditional stigmas associated with that are being removed, which is again coming through consumer education, consumer awareness, and general better education amongst the population. Those are also change of patterns that are taking consumption changes in a different direction. So all this put together is definitely moving in a certain way. Exactly where it's exactly which 50 or 100 touch points it's going to land on, it's impossible for anyone to forecast. But being in the businesses that you are in, you are able to see what the new adjacencies or the new little small delta is that you can cater to. So Hema's being in personal care, beauty, personal care, home care historically, finding these new sweet spots is something that we would establish. But I'm sure any other business which is also catering to consumers in different ways will be able to identify different products that are catering to slightly different demands and different requirements that consumers are having now compared to what they had in the past.
Thank you, Mike, for that answer. So I feel like we have been talking hardcore macroeconomics. So let me zoom in on a sector, right? So Ranjan, this question is for you. So we've seen interest rates stabilize, or I think it's correct to even say slightly move downwards, right? So how is the banking sector handling this margin compression? And how is it impacting the profitability of the banking sector? Enlighten us.
Yes. So, Akna, to answer your question, I think it has to be looked upon from a couple of angles. One thing is, how is it going to affect the net interest income? So, what we have seen so far is when interest rates are coming down, the bank's net interest margins are getting shrunk. But I think we are past that stage now, where we saw rates coming down. For example, we saw AWP around about 20% in 2022, and it has come down and it's below 8% now. And I think that's, as I can remember, it's a 4-year low. We hit last below 8% is October 2021. So we have seen rates coming down, and it's now more or less it's on a stable ground. But when you compare it on a year basis, yes, the net interest margins has come down. So the reduction in interest rates is hitting there. But from the other side, the loan growth that will bring in with the coming in the low interest rates is expected to improve the volume of business. And that is expected to drive the net interest income business of the banks. And from the other side, what we can also look at is through impairments. So what we saw was when interest rates went about 20%, a lot of people are suffering on the ground. And we saw NPLs of the banking sector is rising almost to around 13%. That is, if 100 rupees is given out as loans, 13 rupees is not paid. So that is a significant amount, and we saw how that affected the banking sector profitability, where most of the banks' return on equity, that is ROE, fall into almost a single digit level. So what we can expect is a reversal now. now that the interest rates are coming down, we saw the corporates who were having a bit of trouble with the interest rate finance factor component, we saw them trying to balance out their loan books, balance out their balance sheet, and we saw them taking out and rescheduling or reorganizing their loans to lower interest rates. So, and that together with the recovery in the ground is helped to improve NPLs as well. So, and the interest rates is one of the key components to help that as well. So, yes, we will see a bit of a contraction coming in from the net interest margin side, but we believe that will be offset through loan growth. As we mentioned, we are expecting private sector credit growth to peak at 15% for this year, and following it, it's expected to grow at 12%. So, it's expected to continue to rise, and we will see once economic growth also coming in, this further growing. And so, the negative impact that is coming from the lower interest rates and shrinking margins is expected to be offset by the loan growth, while we will also see benefits coming into the impairment side from low interest rates as well. I hope that answered the question.
Yes. Thank you, Ranjan. So, let me hold on to that last bit that Ranjan mentioned, that while interest rates are coming down, an offsetting factor is going to be the loan growth that we have been witnessing. And Ranjan also mentioned that loan growth is expected to reach around 15% this year. Yeah. So, Joshua, my question now is for you. So, like I mentioned, we've seen a clear expansion, enhancement in private sector credit growth. So, how is this improved access to financing, say for construction projects, particularly in the private residential and commercial segments, impacting the construction sector as a whole?
Okay. Yes, the low interest rates have helped, especially the private sector, to venture into, of course, expand on existing projects and new projects too. So if you look around, you have seen a few projects already ongoing and some to be started out. So that has had an impact, and we have also seen the consumers also investing in residential apartments, for example, because of the affordability of borrowing costs now, and they can get a little bit of more fixed term loans. So yes, that impact we have seen, but I don't know, we are still to see the bigger impact, because that's confused with, we are also in the automobile sector, I must tell you, and we have seen an unprecedented growth in that sector, especially the commercial vehicle sector. We are distributor for Isuzu, and in this financial year, we will be selling an unprecedented maybe over 1,000 trucks this year. So that, and all these banks, most of these are on finance terms, and people are investing in that too. So we have seen that impact of the lower interest rates, not only in the construction sector, but more in the automobile than the construction, but there's traction in the construction sector and condominium sector too.
Okay, thank you, Joshua. So, as my round of questioning is about to come to an end, I would like to end my question on a positive note. Let's talk about growth opportunities for Sri Lanka, right? So, Kushan, this question is for you. With the commissioning of the West Container Terminal, how do you see the port dynamics evolving in Colombo? Will this capacity expansion enable the port to attract greater transshipment volumes and new trade lanes? Tell us what you think.
Yeah. Thanks, Akna. I think the development and commissioning of both the WTC and even the ECT was a dire need. And I think as industry, we have been wanting this to happen for quite some time, especially given that the larger vessels that are coming today, which are about 20,000 TEU plus, which will have a draft of about 18 and 20 meters, was not possible to be accommodated other than partial ECT and CICT. So actually, the last 6 months, we saw a slight dip in the Colombo throughput due to this constraint of capacity, due to the fact that we didn't have capacity and there were some operational issues also. We saw vessels moving to regional ports such as Krishnapatnam, Valappadam, Visnijam, and even we saw some vessels moving to Hambantota, where Hambantota was getting 3 to 4 calls per month. But with WTC and ECT expansion, I think that would be a game changer. And interesting thing is, if you look at the Colombo volumes, 80% is transshipment approximately, and 20% is the domestic. So as Moise and both Joshua mentioned, there is positive sentiments in the local market. Maybe it is somewhat minimum, but there is some growth. But the interesting one is the transshipment volumes. So India today, if you look at it, they are planning to grow at about 7.5% and above over the next decade. They are wanting to transform their economy from a 3.5 trillion economy to a 8 trillion economy, maybe the second or third largest in the world. And when it comes to the container volumes, they are talking about a 20% growth. So that is the growth they have seen since the pandemic, right? So their base is about 20 million TEUs, right? China does more than 300 million. So that is where they are trying to target. So if you take a 20% growth on a base of about 20 million, you're talking 3 to 4 million TEUs. And even with all the port development projects that India are talking about, maybe, I don't know, they are talking about so many, Visnijam coming in, there is another port in Mumbai, Vardhan port. So all those, still there will be a lot of space for growth for the Sri Lankan port. And when I am saying Sri Lankan port, it is not only the port, it is the maritime ecosystem. There is a lot of other areas, the bunkering, the ship repairs, the ship chandling, all those would have positive impacts. The only issue is that Sri Lanka has delayed this, and there is only with the development of the Indian ports coming online. Unfortunately, it might be more short to medium term advantage that we have, unless otherwise we start to add value and, create more attractiveness in the port. But I think it is a game changer.
Game changer. Yes. So that's certainly exciting news for Sri Lanka. And I think this kind of resonates with what Ranjan mentioned also, the cost of inactivity, right? But Sri Lanka is taking action now, even though small in scale, which we should embrace and look at as good news, right? So now we turn to the questions that we have received from the audience. Ranjan, I have a question that I know you love to answer, yes. Right? So the first question from the audience is, the stock market hit their highest level in the last couple of days. Do you think this sharp upward momentum is justifiable, and is it reflective of future earnings given the risk the economy faces both internally and externally?
So Akna, yes, the stock market has gone up, I think, by more than 50% now. And it is reflecting the potential or the future of the Sri Lankan corporate earnings. And as I highlighted here also, we believe that earnings will grow by about north of 25% for this year. And that is the possibility that the retailers are looking at right now in terms of earnings. And we saw last year was a very significant year. And on top of this, we expect the growth to continue as well. So the earnings itself is supporting the growth, while the low interest rate that we are having right now on the ground is also supporting the cost. Because as I mentioned to you before, the the oriented investments that are there to the public because of this low interest rate regime is very less. And that is pushing people to seek more options in terms of investments. And we have been having a lot of talks with the investment community right now, and we are hearing that there's so much liquidity in the market that a lot of people are bringing new money to the market. Some people are changing over from FDs, and some people are moving off from other investment categories into equities, mainly because of the upside. So all these factors combined is pushing the market up. And looking at the outlook as well, as we mentioned here, we believe the low interest rates will continue for at least another 12 months with limited pressure for upside. So this together we will see, and we are expecting this will drive the ASPI to the new heights of 21,000, 20,000 by next year. And we believe that there's a lot of more opportunity in the market right now, but it also on the back of this, we have to mention that market is, as correctly said, it's at all-time high. So from here onwards, not every investment is going to be a great investment. So you should be wise in picking your investment from here onwards, where you will see the earnings as well as the other fundamentals in the company supporting your investment decision rather than picking just another stock. So I think there's more opportunity in the market, and as I mentioned also, we remain very bullish on the equity markets for the next year as well.
Okay. Thank you, Ranjan. I think this next question is for Kushan. So now that imports are opening up and consumer activity is rebounding in Sri Lanka, what developments do you foresee in the logistics and transport sector, and what key challenges still needs to be addressed to unlock its full potential?
I think there are a few trends that we see in the logistics sector. I think we see more and more companies looking at outsourcing, like looking at 3PL type of operations. That is one area that is very apparent. We also see a lot of these companies in the logistics sector looking at technology, right? And to a certain extent, automation. Say, on the technology side, we see a lot of these companies looking at logistics control towers, which give sort of end-to-end access, real-time data, ERP integration with your warehouse management, transport management, and even with your clients and suppliers' systems. So that part, I think we've seen a lot of the companies going and looking at that. On the automation side, I think that's a bit of a slow adoption. I think it's more about the economics. I think Sri Lanka trying to invest in technology sometimes is expensive compared to the lower manpower cost we have. So, but that also I think will get by, going forward, there will be more automation coming in. Green logistics or getting more greener, I think majority of the Western customers are demanding that logistics or end-to-end carbon neutral basis. Even in the industry I am in, the bunkering industry, we are looking at being carbon neutral by 2050, and there are certain stringent requirements that are being imposed even as close as 2028, where all bunkers that we consume, if you don't adhere to certain standards, there will be massive penalties and levies. So on that side also there is certain things. And maybe on the consumer side, I think as what Moise said, there is more and more people looking at e-commerce. So the way how we do logistics has also need to change, right? More traceability needs to be there. You need to, move smaller quantities faster. So those are some of the things. So some of the key challenges may be, I think, funding, infrastructure bottlenecks. Even if you take the Sri Lankan road system, as Joshua mentioned, there are so many delays, so roads are not coming on pace, and so much delays when you go. So those are some of the key things that I see as challenges. Also, the market size is relatively small. So that also has a question about economies of scale. So those are some of the main things I see.
Okay, thank you, Kushan. I think this next question is for Moise. So the audience wants to know what motivated Hemas to venture into local manufacturing of pharmaceutical products, and what is the present status of this?
Okay, that's a hot topic, but good question. So just to give you some very broad statistics first before I get to the point. Sri Lanka's pharmaceutical industry is a $600 million business. And Sri Lanka still imports about 80%, 80, of the total requirement. Whereas if you take the rest of South Asia, India, Bangladesh, Pakistan, they all manufacture about 70 to 100% of their total requirement. So they're pretty much self-sufficient, and the exporters as well, especially countries such as India. So Sri Lanka has a lot of room to really, a big gap to fill in that whole space of pharmaceutical industry. The sheer import substitution is enormous. Now the question is the capability. Practice capability exists. If you take the production facilities in Sri Lanka, some of them meet even the Western European standards. So the capability exists. And the test of the pudding is if you take Hemas, some of the recent products that we have launched in the pharmaceutical spaces, specifically diabetic and cardiac therapies, we've been able to create products that have the efficacy, that have won the confidence of the medical communities itself, has created awareness, and we've been able to achieve market domination within those specific categories, where we're able to offer a substitute to the patients, which is extremely price competitive compared to the imported alternative that is out there. And we do it under our own brands. So you're creating brand equity at the same time. So ability to build, innovate products in the pharmaceutical space that offers the same efficacy under your own brand has so many different phases of benefits. You're creating brand equity. You are offering a product to the patients at a much lower price. You are internally earning a better margin. Plus, you're saving the dollars to the country. It does not get sweeter than that. So there's a lot of scope and space to fill up within Sri Lanka itself. Exports is an opportunity, but that would be the second wave. There's a lot to do to cater to the Sri Lankan need itself. So that's the answer to your question.
Yes, thank you, Moise. Joshua, this question is for you. So I think this question comes in the backdrop of heightened labor migration that we have seen in the recent couple of years. So the question is, are labor shortages and rising wage demands a concern for the construction industry? And if so, how is the sector addressing the skill talent gap to maintain project viability?
It's a very relevant question. So, yeah, post-crisis, of course, the post-economic crisis, we had a lot of migration. Our company has also experienced that, especially some of the skilled people. Of course, there's a big contraction in the construction industry. Minus 20% negative growth in 2023, so big contraction. And obviously the demand also fell off. So immediately there was no real pressure due to the absence of the labor or skills. Thereafter, as Ranjan pointed out, the public expenditure program has not been moving at the pace anticipated. So there are also, there's been restrictions in the demand for labor. But now things are moving. So it depends on the categories of labor also. So depending on the nature of the infrastructure, for example, if it's a road project or if it's a port project or if it's mechanically mechanized work, involving mechanized work, then of course there is sufficient labor, even now skilled labor, and to cater to the current demand. And getting again skills in those particular sectors not very difficult, because the youth labor market there's a big unemployment ratio, I think close to about 20%, yet youth unemployed in this 22 to 28 category. So whenever we need labor, you can absorb. The cost is relevant, relative, because of course the building costs also have gone up, the consumer also. So that is, it's relevant to the current wages which all sectors pay. So that's not a big concern. On the other hand, we have also seen recruitment is not difficult even to the skilled categories at entry level. One is because they need the training, even to migrate. So I'll just give you an example. We had, during the crisis, we introduced a lot of mining, and we had about almost 26 mining engineers leave at the same time. So that was a bit of a hit. But when we advertised to recruit, phenomenal amount of applications, then we realized, okay, they need 5 years experience in a reputed company to get a job in Australia or any different part of the world. So recruitment has also not been difficult. So retention is there in the sense that that experience also is needed. Hopefully things will turn around, that we can retain them in the long term. So yeah, challenges are there, but right now it's a better challenge to deal with, and I'd like to see the projects getting off and running.
Okay, thank you so much, Joshua. We have another banking sector question. Ranjan, I think this I will direct to you. So stage 3 loans have declined and stage 1 loans have also improved. Are there any specific sectors or borrower profiles that still raise red flags in terms of asset quality?
It's a very tough question, Nakna. So as of my understanding, we have seen a lot of activity starting to recover on the ground. And we have seen a couple of big sectors such as tourism and again construction, which were undergoing a bit of a challenging time. During those times, they were starting to recover again. And because of that fact, we saw the NPLs coming down very fast with the recovery that we saw on those sectors. So looking out ahead, I feel right now things are picking up in the economy and we are seeing things coming back to normal. But I don't see any big challenges coming in terms of NPLs as well. But I think partly it's mainly coming from one side as well, partly because of the banks are not aggressive in lending. So what we saw pre-pandemic or pre-economic crisis was that banks were just handing out loans. But now we are seeing banks are targeting specific sort of people. For example, if you look at, when you're speaking to banks right now, what they have been telling us is that everyone is looking at high net worth individuals, the big corporates or the medium-sized corporate to lend. And they are not even like, for example, if I take trying to, for example, the interest rates on a credit card is still at 28%, which was the one same as before crisis. It has not come down. That means the banks are not aggressively looking to push the credit card business, which can create some sort of a trickle-down effect if the economy starts to turn again. So they are not being that aggressive right now, and they are not. The banks are not lending to the SME sector. They are not aggressive there as well. They are selectively lending. So all these things are keeping the possibility for another NPL crisis coming into the banking sector. So I think in terms of I think we have, so as of my knowledge again, we don't see a lot of pressure that is coming into NPLs, and we don't see a lot of pressure from certain sectors as well towards NPLs as well. So I don't see a lot of pressure.
Okay, thank you so much, Ranjan, for that question. I think this next question again is for so I will once again have to turn to you, Ranjan. A lot of equities related questions that we've seen coming in. So this is also, I think, a very timely questions with the economy opening up to vehicle imports as well. So the question goes as, there's a steep rise in vehicle imports and other major imports, which will result in a heavy outflow of foreign currency. I think this is a reality that Sri Lanka has dealt with for many, many years, during and even before the crisis. So the question is, what kind of impact would this have on the Colombo Stock Exchange? Is there an impact? If so, what is the nature of it?
I think it's very difficult to assess what is the direct impact out of it going to be. I think part of it can be that it will increase the competition of the local industries. For example, such as consumer and all, we are seeing now that now that the imports are opened up, we see a lot of small gadgets and small stuffs coming into the country again, and it's freely available there in every place now. So I think it brings a certain amount of competition to the local market, and them competing with the very reduced price from coming from China and all, I think it's it may create a bit of a challenging situation. But to be honest, I don't see a lot of challenges coming in from there. But something again is that now there are few talks now that we are hearing a lot of people that now that the vehicle imports is almost at around, I'm hearing that about $800 million has been opened for in terms of LCs. And the budget government, the central bank was only ready for $1 billion. So we are almost near that threshold where the central bank expected, and if that can drain out any reserves in the country. But I think now that what we are, again, compared to before, where we were, the country was trying too hard to hold on to the dollar at 200 while sacrificing reserves. Compared to that, now I think we have a lot of checks and balances in the system. So I think if we see something like imports going out of hand, we will see probably it getting reflected on the dollar. And it will naturally, the demand itself will come down naturally because the dollar will increase and it will reduce the purchasing power of the people. So there may be a new checks of balance now there that is not there in the system right now. So imports itself, I don't see a lot of problems coming in from imports, but I'm sure it will add in another level of challenge for all the gentlemen who are here with the imports opened up.
Okay, thank you, Ranjan, for your answer. So with that, it looks like we have reached the end of our forum. So before we wrap up, let me extend my deep gratitude to our panelists here. Having you here, your willingness to be here and to share your insight and expertise has made all the difference. It truly was a rich and engaging conversation. I certainly learned a lot. And then also to all of our viewers, thank you so much for being a part of the forum today. Your engagement and feedback means a lot to us. So to our viewers, once again, please note that there will be a questionnaire at the end of the forum giving you an opportunity to give us feedback on areas where we can improve. So I think with that, we've reached the end of the forum. Thank you all so much again for being a part of this event today.